Have you ever wondered why some investors seem to consistently position themselves ahead of major gold price movements, while others are perpetually playing catch-up? The difference often comes down to which indicators they're watching. While most investors fixate on the obvious metrics like spot prices and interest rates, the truly savvy players are monitoring something entirely different, something that has preceded every major gold bull run in the last 50 years. Today I'm going to reveal this overlooked indicator that's currently flashing a signal we haven't seen since 2001, right before gold began its decade-long ascent from $250 to over $1,900 per ounce. This isn't speculation. It's a data-driven analysis based on historical patterns that have repeated with remarkable consistency. Let me take you back to August 1971. President Nixon had just closed the gold window, ending the convertibility of dollars to gold. In the months that followed, most investors were watching inflation numbers and currency fluctuations. But a small group of market veterans were tracking something else entirely: the ratio between central bank gold purchases and their foreign exchange reserves. This obscure metric began showing an unusual divergence pattern 6 months before gold prices exploded upward. Fast forward to January 1980, when gold hit what was then an all-time high of $850 per ounce. In the 18 months prior, this same indicator had been steadily climbing, yet mainstream financial media never mentioned it once. Not a single time. The same pattern emerged before the 2011 peak, with our indicator showing clear signals by mid-2009. What makes this particular metric so powerful is that it's not manipulated by the paper gold market. It's not influenced by futures contracts or ETF flows. Instead, it measures actual physical gold movement at the highest levels of the global financial system, the kind of activity that precedes major repricing events. Now here's where things get truly fascinating. This indicator has just broken through its historical threshold level for the first time since 2001. The last time we saw a reading this strong, gold was sitting at $250 per ounce before beginning a 600% ascent over the next decade. And yet, I've checked Bloomberg, CNBC, Reuters, and the Wall Street Journal. Not one of them has reported on this development. It's hiding in plain sight. Let me explain exactly what this indicator measures and why it matters so much right now. At its core, it tracks the relationship between two critical data points in the gold market: the ratio of central bank gold purchases to their stated monetary policy objectives. When these two metrics diverge beyond a certain threshold, it has historically signaled a fundamental shift in how these institutions view gold's role in the global financial system. Consider what's happening with central banks right now. In 2022, they purchased nearly 1,136 tons of gold, the highest level since records began in 1950. In 2023, they bought another 1,037 tons. That's over 2,100 tons in just 2 years. For context, the entire annual global mine production is only about 3,000 tons. Central banks are accumulating gold at a pace we've never seen before. But here's the critical insight. It's not just how much they're buying, but who's doing the buying and how they're doing it. Countries like China, Russia, Poland, Turkey, and India have been the most aggressive purchasers. What's particularly telling is that many of these purchases are happening outside the traditional London and Swiss markets. They're being conducted through direct mine acquisitions, bilateral country-to-country transactions, and newly established alternative trading systems. This brings me to a fascinating historical parallel that few analysts are discussing. In the late 1960s, before the collapse of the Bretton Woods system, central banks, particularly the French under President de Gaulle, began quietly converting their dollar reserves to gold. They could see the structural problems with the dollar and moved to protect their national wealth. This accelerated gold outflows from the U.S. Treasury and ultimately forced Nixon's hand in closing the gold window. Today, we're seeing a similar pattern, but on a much larger scale and with more participants. The BRICS nations, Brazil, Russia, India, China, and South Africa, plus their new members, have openly discussed creating alternatives to the dollar-based financial system. Their central banks are accumulating gold at record pace while simultaneously reducing their U.S. Treasury holdings. Let me share some specific numbers that illustrate the magnitude of what's happening. Russia has virtually eliminated U.S. Treasuries from its reserves while increasing its gold holdings from about 400 tons in 2007 to over 2,300 tons today. China officially reports holding about 2,113 tons, but many analysts believe the actual figure could be 2 to 3 times higher based on domestic production and import figures. What's particularly telling is how these purchases accelerated following the freezing of Russia's foreign exchange reserves after the Ukraine invasion. That single event fundamentally changed the risk calculation for every central bank in the world. Suddenly, foreign exchange reserves held in Western financial institutions were revealed to be potentially vulnerable to geopolitical conflicts. Gold, held domestically, faces no such counterparty risk. This brings us to the current market structure, which few retail investors truly understand. The gold market operates on a fractional reserve system, not unlike banking. The amount of paper gold, futures contracts, ETF shares, unallocated accounts, far exceeds the physical metal backing these instruments. By some estimates, there are over 100 paper claims for each ounce of physical gold available for delivery. This system works fine under normal conditions, but becomes vulnerable during periods of high demand for physical delivery. We're now seeing early signs of stress in this system. COMEX registered gold inventories, the gold actually available for delivery against futures contracts, have fallen to multi-year lows. Meanwhile, the premium for physical gold in places like Shanghai has been running well above normal levels. And that brings me to a quick aside. If you're sitting on $100,000 or more in retirement accounts, I've put together a free guide on how gold IRAs work. It's in the description below. The guide covers how to get physical gold into your retirement account without triggering tax penalties. It's particularly relevant given what we're discussing today, about physical ownership versus paper claims. Worth checking out if that applies to your situation. Now, back to our analysis. The indicator I've been discussing is showing something remarkable about institutional behavior. Major sovereign wealth funds, which have traditionally avoided gold allocations entirely, have begun establishing new positions. The Norwegian Sovereign Wealth Fund, the world's largest at $1.4 trillion, has been evaluating adding gold for the first time in its history. When institutions of this size begin entering a market with limited supply like gold, the price implications can be enormous. There's another dimension to this that involves the mining sector. Gold discovery rates have plummeted over the past decade. Major gold discoveries, defined as deposits over 2 million ounces, have become increasingly rare. In the 1990s, the industry found 124 major gold deposits containing 1.1 billion ounces. In the last decade, only 41 major discoveries were made, containing 363 million ounces, a 67% decline. Meanwhile, the average grade of gold mined globally has fallen from over 2 grams per ton in the early 2000s to about 1 gram per ton today. This means mining companies must process twice as much ore to produce the same amount of gold, significantly increasing production costs and environmental impact. The combination of central bank buying, declining discovery rates, and falling ore grades creates a powerful supply constraint, just as institutional demand appears to be accelerating. This is precisely the type of fundamental imbalance that our indicator is designed to identify. Let me share a telling anecdote that illustrates how serious this situation has become. In March of last year, a major European bank client attempted to withdraw 400 ounces of allocated gold, worth about $800,000, from a Swiss vault. Despite having full legal title to specific, serialized bars, the client was told it would take 3 to 4 weeks to fulfill the request. For context, pre-2020, such requests were typically fulfilled within 2 to 3 days. This kind of delivery delay for allocated gold is virtually unprecedented and suggests significant tightness in the physical market. Now, you might be wondering why, if this indicator is so powerful, more investors aren't aware of it. The answer lies in how the gold market is covered by financial media. Most analysis focuses on short-term price movements, technical patterns, and the relationship between gold and real interest rates. These factors certainly influence day-to-day trading, but they miss the deeper structural changes occurring beneath the surface. It's also worth noting that major financial institutions have complex relationships with the gold market. Many operate significant paper gold trading desks that benefit from the status quo. They have little incentive to draw attention to indicators suggesting potential stress in the physical market or major repricing events. This information asymmetry creates opportunity for investors willing to look beyond mainstream narratives. Throughout history, the greatest wealth transfers have occurred during periods of monetary regime change. precisely the type of event our indicator has excelled at identifying. Consider the implications if the current signal is accurate. The last 3 times this indicator reached current levels, gold experienced gains of 590%, 1971-1980, 650%, 1999-2011, and 40%, 2015-2020. And in each case, the gains in select mining companies were many multiples of the move in gold itself. What makes the current situation particularly compelling is the broader macroeconomic backdrop. Global debt has reached unprecedented levels, with the U.S. federal debt now exceeding $34 trillion. The Federal Reserve's balance sheet, despite recent tightening efforts, remains nearly 9 times larger than before the 2008 financial crisis, and governments worldwide continue running substantial deficits with no credible path to fiscal sustainability. These conditions create powerful incentives for financial repression, keeping interest rates below inflation to gradually erode the real value of outstanding debt. Such environments have historically been extremely favorable for gold, which maintains its purchasing power while financial assets denominated in fiat currencies lose real value. But there's an even more fundamental shift occurring that few investors appreciate. For decades, the global financial system has operated on what economists call the dollar milkshake theory, where the U.S. dollar's reserve currency status allowed America to export inflation to other countries. Foreign central banks were essentially forced to recycle their trade surpluses back into U.S. treasuries, suppressing U.S. interest rates and funding American deficits. This system is now showing signs of structural breakdown. The percentage of global trade conducted in dollars has declined from 85% in 2000 to about 59% today. BRICS nations are actively establishing alternative payment systems that bypass SWIFT and the dollar entirely. And perhaps most tellingly, the ratio of global central bank gold purchases to U.S. Treasury purchases has inverted for the first time since the early 1970s. What does all this mean for gold prices going forward? If history is any guide, we're in the early stages of a major repricing event. The last time our indicator reached current levels and the macroeconomic conditions were even remotely comparable was in 2001. Gold proceeded to rise from $250 to over $1,900 over the next decade. But there's reason to believe the current move could be even more dramatic. In 2001, global debt to GDP was far lower, central bank balance sheets were a fraction of their current size, and the dollar's reserve status was largely unchallenged. Today, all these factors are significantly more extreme, creating the potential for an even more powerful gold bull market. It's also worth considering the starting point. Despite reaching nominal all-time highs, gold remains well below its inflation-adjusted peak from 1980, which would be equivalent to about $3,000 per ounce in today's dollars. And relative to global money supply, gold is still near historical lows. Now, I want to address some potential counterarguments. Critics might point to rising interest rates as a headwind for gold, which pays no yield. This perspective misses 2 critical points. First, while nominal rates have risen, real rates, adjusted for inflation, remain negative in many countries. Second, our indicator has historically been most accurate during periods of monetary regime change, when traditional correlations between gold and interest rates often break down. Others might argue that cryptocurrencies like Bitcoin have replaced gold as the preferred alternative asset. While digital assets certainly compete for investment dollars, they serve different functions. Bitcoin offers potentially higher returns with significantly higher volatility and regulatory uncertainty. Gold provides millennia of monetary history, universal recognition, no counterparty risk, and cannot be created through a software update. The 2 assets are complementary rather than mutually exclusive in a diversified portfolio. Let's also consider the technical picture, which supports the fundamental case. Gold has recently broken out to new all-time highs after a 3-year consolidation period. Such breakouts following multi-year bases have historically led to substantial moves higher. The measured move target from the recent breakout suggests a minimum price objective of $2,500, with potential for significantly higher prices if our indicator's historical relationship holds. What's particularly interesting about the current market structure is the disconnect between paper gold markets and physical demand. ETF holdings have actually declined over the past year, even as prices have risen, a highly unusual divergence. This suggests the price rise is being driven by physical demand rather than speculative interest, which typically makes for a more sustainable bull market. The mining sector provides another compelling opportunity. Gold mining stocks, as measured by the GDX index, are trading at historically low valuations relative to the gold price. The last time we saw this level of undervaluation was in the early 2000s, right before the sector delivered returns of over 1,000% in the subsequent bull market. As we look ahead, there are several potential catalysts that could accelerate gold's move. Further geopolitical tensions could prompt additional central bank buying. A recession could force the Federal Reserve to reverse course on monetary tightening, and any crisis of confidence in the banking system, like we saw glimpses of in March 2023 with Silicon Valley Bank, could drive substantial safe haven demand. But perhaps the most powerful potential catalyst would be a formal acknowledgement of gold's role in a new monetary framework. There have been increasing discussions among international financial authorities about the potential for a new Bretton Woods-type agreement to address global imbalances. Any such framework that included a role for gold, even partially, would fundamentally revalue the metal higher. In conclusion, the gold indicator I've discussed today is flashing a signal we haven't seen in over 20 years. The combination of record central bank buying, declining mine supply, and structural shifts in the global monetary system creates a compelling case for gold exposure. While mainstream financial media remains focused on day-to-day price movements, the deeper structural changes suggest we're in the early stages of a major bull market. Those who recognize this signal now, before it becomes widely acknowledged, have the opportunity to position themselves ahead of potentially historic moves in the gold market. Just as those who identified the early signals in 1971 and 2001 were richly rewarded, today's indicator offers a similar opportunity for forward-thinking investors. The question isn't whether gold will respond to these fundamental forces. History shows that it inevitably does. The question is whether you'll be positioned to benefit when it happens. The indicator is flashing now. The signal is clear. The opportunity is present. The rest is up to you.